Welcome to the deep dive, your shortcut to being well-informed. You ever feel that background hum of financial stress?
Mhm.
Or like you're playing a game, but maybe you don't quite know all the rules.
Yeah, that's incredibly common. Way more common than people probably talk about.
Exactly. And it can feel isolating, right? But today, we're going to try and cut through some of that noise.
Right.
This deep dive, it's all about demystifying money, turning it from, the source of anxiety into, well, into a tool, a powerful one, for building the life you actually want. And we're drawing heavily on a really solid framework today called 7 Steps to Financial Freedom. It lays out a surprisingly clear roadmap.
It really does. Very actionable.
So our mission for you listening is that you walk away with more than just ideas. We want you to have a real actionable game plan.
Yeah, concrete steps.
We'll uncover some maybe surprising things about how money works and definitely some practical strategies, stuff that can shift you from feeling stuck to, actively building wealth. Because honestly, if you've ever thought, oh, I'm just bad with money, well, it's probably not entirely your fault. We aren't really taught this stuff, are we?
Not usually. No, not in practical way.
But it is your responsibility now, I think, to learn. Money isn't magic, it's a skill.
Exactly. It's a skill you can learn, practice, and actually get good at.
Like learning the rules of any game, right? Once you know them, you can start working towards winning.
That's the core idea. Shifting from just reacting to money, maybe feeling stuck by it, to intentionally using it to build something. It's a total transformation.
Okay, so let's dive into this journey. The source is really clear that the absolute first step, the foundation, is fixing your mindset.
Crucial.
It sounds maybe a bit soft, but think about the beliefs we carry. Like, is money evil? Is getting wealthy somehow wrong? Or just for lucky people?
Yeah, or that you have to sacrifice everything good to earn more. Those narratives are powerful.
They really are. And they can totally sabotage you without you even noticing. This framework challenges that head on. Money isn't good or bad. It's just a tool.
A neutral tool.
Exactly. And specifically, a tool for freedom. So maybe think about this. How would changing your thinking, seeing money as a lever for independence, how might that change how you approach things? Earning, saving, investing?
That shift is fundamental. Because our beliefs, they directly drive our actions, often subconsciously.
Right.
If you think talking about money is, I don't know, crass,
Yeah.
you'll avoid important financial conversations, maybe miss opportunities. If you're suspicious of wealth, you might unconsciously push it away, even if you say you want security for your family or want to support causes you care about.
Yeah, you create your own roadblocks.
Precisely.
Right.
So consciously seeing money as a tool for freedom, freedom of choice, freedom to build, freedom to give back, it dismantles those internal barriers. It's not just positive thinking, it's strategic alignment. Getting your internal beliefs lined up with your external goals. That really sets the stage for growth.
That makes perfect sense. And it flows right into the second step, which is learning the game. Because most of us, let's be honest, are primarily consumers. We earn money, we spend it. End of story, mostly.
Yeah, that's the typical cycle.
But the 7-step source draws a really sharp line here. It says, while everyone spends money, it's the investors who really understand the rules and use them to build wealth over the long term.
Right. It's not about being greedy. It's about being informed, strategic.
Knowing how the system actually works.
Exactly. And the source boils it down to 3 key rules. Once you grasp these, your perspective can totally shift. First one, money flows to investors. Simple as that.
Okay. Explain that a bit more.
Well, think about it. When you buy something, a coffee, a phone, whatever, your money goes to the business that sold it.
Right.
But if you invest in that business, or others like it, through stocks or maybe bonds or real estate, then a piece of the profit or the value being created flows back to you.
Ah, okay. So you're on the receiving end, not just the spending end.
Precisely. You shift from just being part of the expense column to participating in the wealth creation. You're getting a piece of the action, so to speak, where capital tends to gather. The second rule is one that trips people up sometimes. Inflation actually helps investors.
Wait, how? Inflation makes things more expensive, right? Eats away at savings.
It does eat away at the purchasing power of cash, yes. But think about businesses. When prices go up, the price of their products, their services.
Their revenue goes up.
Exactly. And often the value of the assets they own, like property or equipment, also increases with inflation. So if you own a piece of those businesses or assets like real estate yourself, the value of your investment tends to rise with inflation. or maybe even faster.
Okay, so while cash loses value, assets can actually gain value because of inflation.
Right. It effectively transfers some wealth from people holding onto cash or maybe bonds that don't keep pace to those holding assets that appreciate. Understanding that dynamic is really key for protecting your wealth over time. And the third rule, often missed. The tax code tends to favor investors.
How so? Isn't everyone trying to pay less tax?
Well, yes, but the way income is taxed often differs. In many places, like the U.S., income you earn from investments held long-term than capital gains on stocks, or certain dividends, is often taxed at a lower rate than the salary you earn from your job.
Ah, okay. Different tax brackets for different types of income.
Exactly. Plus, investors have access to specific tools like retirement accounts, 401ks, IRAs, or health savings accounts where money can grow tax-deferred or even tax-free. Real estate investors get deductions like depreciation.
Right. Things you don't typically get just from a paycheck.
Correct. So for you listening, if most of your income comes from a job, the insight here is to start figuring out how you can use these existing rules. How can you shift more towards being an investor, legally and strategically, so taxes don't eat up such a big chunk of your earnings? It's about playing the game by the rules that exist.
Okay, that really highlights the importance of understanding the system, not just being
Mm.
subject to it. So we've got the mindset, we understand the basic rules. But what if you're feeling totally overwhelmed right now, like drowning in debt?
Yeah, the where do I even start feel.
Exactly. That's where step 3 comes in. Getting out of the danger zone.
Yeah.
This isn't long-term strategy yet. This is like financial first aid, urgent stuff.
Triage, yeah.
The source points to 3 absolute must-dos here. First, build a $2,000 emergency fund. Like right now.
Non-negotiable.
Yeah. This is your immediate shield. Car breaks down, unexpected bill. This stops a small problem from derailing everything.
Mm-hmm.
Second, get super aggressive about paying off high-interest credit cards. We're talking 20%, 25% interest.
That's just killer.
It's a killer. It's like running on a treadmill that's speeding up. You're just making the banks richer and keeping yourself stuck.
Totally. And third, cut back hard on non-essentials for now.
Mhm.
This isn't forever, right? It's about freeing up cash and mental energy immediately. All right. Temporary, focused sacrifice to gain breathing room. Get some momentum.
Create that space so you can actually move forward.
And, the psychological impact of these first steps is huge. That $2,000, it's not just money, it's peace of mind. It lets you think clearly instead of panicking when something goes wrong.
Yeah, less desperation.
Exactly. And killing that high-interest debt, wow, that's like giving yourself an instant raise. Every dollar you stop sending to the credit card company is a dollar back in your pocket.
That's a great way to put it. A guaranteed return.
The best guaranteed return you'll likely ever get. So yeah, these actions create the stability you absolutely need before you can really start building anything substantial.
Okay, so you've fought your way out of the immediate danger zone. You've got a little breathing room. What's next? Step 4 is about being proactive.
Yeah.
Building a money system.
Right, moving from reactive to intentional.
Because most of us, like we said, just kind of earn, spend, hope something's left.
Mm-hmm. Maybe save, maybe not.
This flips that script. It's
Yeah.
about setting up a system so your money starts working for you automatically the second it arrives.
And the system the source recommends is actually pretty straightforward but really effective. First, it suggests having 3 separate bank accounts.
Okay, why 3?
One is purely for your regular spending, bills, groceries, day-to-day stuff. Another is strictly for saving the emergency fund top-ups, short-term goals. And the third is dedicated solely to investing.
So clear buckets for different jobs.
Exactly. It
Yeah.
creates mental separation. It stops you from accidentally spending your savings or investment money because it's all jumbled together. Then, the second part is key. Automate your paycheck.
Meaning?
Set up your direct deposit so that when you get paid, the money automatically splits and goes into those 3 accounts before you even touch it.
Pay yourself first. Literally.
Literally. Your savings contribution, your investment contribution, they happen automatically. It takes willpower out of the equation for those crucial goals. It just
Yeah.
happens. Protects you from yourself, in a way.
Prevents that lifestyle creep where more income just means more spending.
Precisely. Your future gets funded first. And the third piece is a guideline, a rule of thumb.
Yeah.
The 7-5-1-5-10 rule.
Okay, break that down.
The idea is aim to live on no more than 75% of your income. That covers all your spending. Then commit to investing at least 15% and saving at least 10%.
So 75 spent, 15 invested, 10 saved. Minimums.
Exactly. Minimums. If you can do better, great. Invest more, save more, especially if you have higher income or really ambitious goals. But this provides a solid starting structure. It forces you to allocate money to building wealth before it can disappear into discretionary spending. Every dollar gets a job.
That system feels really powerful because it's proactive, not reactive.
Yeah.
Okay, so the money's flowing into the right buckets automatically. What's step 5? It's about spending smarter.
Right. This goes beyond just basic budgeting. It's about being strategic with the money you do spend and save.
Okay, so what does smarter look like here? Well, first, building up that emergency savings. We started with $2,000 to get out of danger, but the goal here is 3 to 12 months of essential living expenses.
That's a serious cushion.
It is.
Yeah.
But imagine losing your job or having a major health issue. This buffer means you don't panic, you don't have to raid your investments or go back into debt. It buys you time and options.
Peace of mind, again. But on a bigger scale.
Exactly. Second principle, always be investing, even small amounts.
Consistency is key.
Totally. $10 a week, $50 a month, whatever you can manage consistently. Get that money working while you sleep. That's compound interest kicking in.
Yeah, starting that snowball, rolling down the hill, even small starts make a huge difference over decades.
And the third big one, underspending smarter. Don't finance things that go down in value. Non-appreciating assets.
Oh yeah, this is a big trap.
Huge.
Yeah.
Getting loans for furniture, phones, fancy cars. You're paying extra interest for something that's losing value the moment you buy it. Often, you end up owing more than it's worth pretty quickly.
Right. Bad debt.
The source makes basically one exception. Maybe a mortgage on your main home, because historically homes can appreciate and it forces saving. But otherwise, if it doesn't grow in value or make you money, pay cash or don't buy it.
And that distinction you made between good debt and bad debt, that's critical. Good debt helps you buy an asset that ideally grows in value or produces income like a mortgage on a sensible house, or maybe a loan for a business that generates profit.
Right. Leverages your money.
Yeah. Bad debt just makes you poorer. High-interest credit cards, car loans on rapidly depreciating vehicles, it actively drains your wealth. And when we talk about money working while you sleep, that's compounding. The real magic isn't just that it compounds, but the time it has to compound.
The earlier, the better.
Massively better. Starting small, early, beats starting big, late, almost every time because of that long runway for growth. Don't let thinking it's not enough stop you from starting something.
Okay, mindset, rules, danger zone clear, system built, spending smarter. But maybe you're doing all that and still feel like you need more fuel for the fire. Step 6 addresses that. Making more money.
Yeah, boosting the income side of the equation.
But critically, the source warns against the calming trap. Earn more, spend more, lifestyle inflation.
Right. The goal isn't just to earn more so you can buy more stuff. It's to earn more so you can invest more.
Keep your spending relatively stable and funnel that extra income straight into your investment account.
That's the strategy. Widen the gap between earning and spending. And there are practical ways to do this. The source suggests a few key paths. One is obvious. Get a side hustle, use skills you have, learn new ones, freelancing, consulting, turning a hobby into cash.
Extra income stream.
Another is to actively upgrade your skills for your main job, get certifications, specialized training, things that make you more valuable in the market.
Increase your earning potential where you are.
Or sometimes the quickest way is to just switch jobs. Find a company that pays better for the skills you already have.
Yeah, loyalty doesn't always pay the bills.
Unfortunately, not always. And for those with an entrepreneurial itch, maybe start something small on the side, a micro business, even if it just brings in a little extra at first.
But the key is what you do with that extra money.
Absolutely. Treat it like bonus investment fuel, not just extra spending money. That's how you really accelerate things.
Okay, almost there. You've done all this work, you're building wealth, you have a system. Now, the final step, step 7, which is easy to forget but so important, protect what you build.
Yeah, safeguarding your progress, building the fortress walls.
Because life happens, right? You need to make sure what you've built isn't vulnerable.
Right. And this involves bringing in some professionals and using the right tools. The source highlights 3 key areas. First, lawyers.
Not just for lawsuits.
No, definitely not. Proactively. For your will, setting up trusts if needed, handling real estate deals properly, structuring a business. They make sure things are legally sound, your wishes are clear, your assets are protected.
Okay. Secure the legal foundations. Second, insurance. The right kinds, the right amounts. Home, health, auto, maybe life insurance depending on your situation. It's your financial shield against catastrophes.
Things that could wipe you out financially otherwise.
Exactly. You're transferring that massive risk away from yourself for a manageable premium. And third, accountants.
To help with taxes.
Yes, but more than just filing. A good accountant helps you strategize. Find legal deductions, structure things efficiently, make sure you're compliant. They help you keep more of the money you make so it can keep growing. And just to make this super concrete, the source gives some immediate actions you can take, like today. Open that separate savings account if you haven't. Set up automatic investing, even just $10. Pick one high-interest debt and attack it. Find one subscription or recurring cost you don't truly need and cancel it.
Small steps, big impact.
They really are. They get the ball rolling. They activate the plan.
Wow. Okay, that was quite a journey through the 7 steps to financial freedom.
Yeah.
From mindset and rules, through digging out of debt, building that automated system. Yeah, the practical mechanics.
To spending smarter, earning more intentionally, and finally, putting those protections in place.
Covering all the bases.
It really hammers home that idea, doesn't it? Financial freedom isn't some lottery win. It's a skill. You learn it, you practice it.
Absolutely. It's built through consistent, intentional steps, not overnight magic.
So our goal with this deep dive was to give you that clear path, those actionable steps, not just theory to make you feel overwhelmed.
Yeah, hopefully it feels achievable, broken down like this.
We really hope you feel ready to take just one small step, maybe even right after listening. Just pick one thing from step 7, maybe, or step 3 if you're there. Start now.
Momentum is powerful. And maybe leave you with this thought to chew on. If money really is a tool for freedom, once you feel like you've learned the game, once you start mastering it, what kind of freedom are you going to build?
Ooh, good question.
What will that power, that possibility actually unlock for you and the people you care about? What kind of life, what kind of impact?